Welcome to this explainer. Today we're popping the hood on a fascinating and honestly highly sophisticated financial engine, the Titanium Equity Long-Short Fund. We're going to look at an institutional-style strategy that's designed not just to ride the market's peaks, but to actively navigate its deepest valleys.
Okay, let's do a quick run-through of our roadmap today. 1. The volatility problem. 2. The long-short solution. 3. Navigating market phases. 4. Constructing the portfolio. And 5. Understanding the risks.
All right, let's dive right into Section 1, the volatility problem and how we actually navigate market drops.
So look, most traditional investing focuses pretty much entirely on that charging bull you see on the left. You buy, you hold, and you just sort of hope the market goes up. But the reality of financial markets? Well, it's that you also have to race right alongside the bear on the right. Markets inevitably pull back, they correct, and yeah, sometimes they crash.
Which brings us to a really critical question. What if your portfolio wasn't just built for the straightaways? You see, traditional portfolios generally only make money when the overall market goes up. And that leaves your wealth incredibly vulnerable when the track inevitably curves and the market heads south.
Now, what's truly fascinating to me is looking at this historical Nifty 50 drawdown data. Just look at those deep, jagged valleys in the green line. And more importantly, look at the blue lines mapping the absolute bottom of those drops. This simulated data proves that market recoveries severely test your patience. We are not just talking about a bad week or a bad month here.
Here is the real kicker. During these major downturns, your portfolio often sits in the red for more than 100 days, over 100 days. And sitting in a drawdown for that long isn't just psychologically painful, it's a massive, massive loss of valuable time for your portfolio's growth. It's basically dead time, where your money is just trying to claw its way back to zero instead of actually compounding.
So how do we fix that? Let's move to Section 2, the long-short solution, where we'll see how to cushion that blow.
Let's bust a very common myth right out of the gate. You don't only have to make money when markets go up. This specific fund uses what's called an equity long-short strategy. Now, going long is what you already know, right? You're buying stocks you expect to increase in value. But going short? That involves selling borrowed shares of stocks that you expect to decline, with the goal of buying them back later at a lower price. By holding both positions using derivatives, you can potentially profit from, or at the very least cushioned against, falling prices.
And get this, because this is a genuinely surprising fact. Even in varying market conditions, on average, 20 to 30 stocks within the Nifty 50 generate negative monthly returns. Let that sink in. Even when the broader market feels like it's absolutely crushing it, almost half the index is actually in the red.
Finding those 20 to 30 underperforming stocks is the massive untapped opportunity this fund seeks to leverage. Rather than just letting those weak links drag down a passive index, the fund attempts to pinpoint them using fundamental analysis and then short them. It's really all about turning the market's weak links into a powerful source of downside protection.
Okay, moving right along to Section 3, Navigating Market Phases. Let's talk about shifting gears. So how does the fund actually adapt to the terrain? Well, it's designed to dynamically shift across 3 distinct market environments. Think of it like a professional race car driver. They wouldn't use the exact same tires for a dry, sunny track as they would for a slick, rainy one, right? Similarly, this strategy uses completely different exposures depending on whether we're in a bull market, a range-bound market, or an overvalued market. Let's break down how those gears actually shift. In Step 1, a bull market, the fund steps on the gas with unhedged long derivatives to really capture that upside. In Step 2, a range-bound market where things are just kind of moving sideways, it dynamically manages both the longs and the shorts to try and squeeze out returns while keeping volatility low. And finally, Step 3, when the market is overvalued and looking risky, it acts like a giant shock absorber by significantly increasing its hedges and unhedged short positions to cushion any impending falls.
All right, Section 4, Portfolio Construction. Let's look under the hood.
Looking at this schematic, you'll notice that the core of the engine is heavily equity-based. It maintains an 80 to 100% allocation in equity and equity-related instruments. But the true customization, the real secret sauce, comes in with the allowance of 0 to 25% in unhedged short derivatives and up to 20% in debt and money market instruments. That's there to maintain liquidity and tactically manage the risk.
Which brings us to Section 5, Understanding Risks, because safety absolutely has to come first. Just like any high-performance vehicle, you really need to understand the brakes before you hit the accelerator. So to be completely impartial here, we have to highlight this stark regulatory warning pulled straight from the fund's documentation. While short selling can cushion falls, it comes with a very unique, asymmetrical risk. If you buy a stock, the absolute worst it can do is go to zero, right? But if you short a stock, the price can theoretically rise infinitely. As the documents note, if a manager shorts 1,000 shares at 650 rupees hoping they drop, but the price suddenly skyrockets to 900 rupees, the portfolio ends up losing 250,000 rupees. Your potential losses on a short position are literally, theoretically unlimited.
And the risks do not stop at a potential short squeeze. The active use of derivatives introduces leverage risk. Leverage basically means that rapid market moves against the fund can quickly and severely amplify portfolio losses. Plus, during times of extreme financial stress, complex derivatives might suddenly lack liquidity. That means the fund might actually struggle to close out a position when it needs to. Oh, and there is also counterparty risk if the fund uses credit default swaps, which essentially means the institution on the other side of the trade might default on their obligation.
So, if this strategy aligns with your specific goals, timing's pretty important here. The new fund offer window is scheduled from April 27th to May 11th, 2026. So that gives you a very specific time frame to consult your financial advisor and see if this fits your overall engine.
As we wrap up this explainer, I really want to leave you to consider your own financial strategy. The market is always going to have its share of straightaways and terrifying hairpin turns. So, is your portfolio currently equipped with the shock absorbers required to handle those inevitable twists ahead? Or are you just kind of hoping the track stays straight forever? Something to think about. Thanks so much for learning with us today.